have done earlier. Now, on today's show, we're asking whether equity-linked saving schemes, which are clearly one of the most popular equity mutual fund categories, if they're the best tax-saving option even today. And if they are, how should you select which one to invest in? To answer some of those questions, I've got Shalini Sekhri, who is the Chief Executive Officer at Infinity Asset Advisors, and Suresh Sadagopan, who is MD and Principal Officer at Ladder 7 Wealth Planners. Thank you so much to the both of you for joining in. Pleasure speaking with you as always. Let's, for the uninitiated, break things down very simply at the start. Shalini, I'll come to you. How would you describe ELSS? How does it work?
So, hi Alex, great to be here as always and right at the start of the year and the tax season. An equity-linked savings scheme is nothing but a mutual fund category product really. So it's nothing but a scheme that allows certain tax benefits. So in fact, it is the only kind of mutual fund scheme that comes bundled with tax saving benefits. So these combine all the benefits of equity investing along with tax deductions that are available to us as investors under Section 80C. So through ELSS investing, you can reduce your taxable income by up to 1,50,000 a year. As I mentioned, ELSS funds are actually equity oriented and at least 65% of their portfolio has to consist of equity linked securities. So typically these are almost entirely equity oriented schemes. So it's an asset class that's extremely suitable for a long-term investor who has a horizon of say 3 years or more. And this aligns very well with the fact that ELSS comes with a 3-year lock-in that's mandatory. Now, of course, being an equity-oriented product, ELSS offers the potential for high returns. Of course, that comes with an associated risk as well linked to the market. But when you combine this with the tax-saving aspects, it makes it a very popular choice for investors. So, Alex, if I were to look at the other options today under the 80C tax benefit avenues, you have ones like the NPS, PPF, Senior Citizen Savings Scheme, all of which are in general fixed returns and generally single-digit returns in nature, and also come with a longer lock-in. And that's the reason really that ELSS finds extremely high favor amongst investors in general. One point I wanted to make here is that it's important for investors to understand that while, yes, ELSS does bring tax benefits, the return or the income from an ELSS investment is not completely tax-free. So when an investor is redeeming and exiting an ELSS scheme post its lock-in, it cannot attract short-term capital gain, of course, because it's a 3-year hard lock-up. So it would attract a long-term capital gains tax, which, as we know, gains up to 1 lakh a year are exempted and are tax-free. And above that would attract a long-term capital gain tax rate of 10% with surcharge and cess. Right. Dividends, of course, on a last point, would get added to your income and taxed at your slab rate.
Fantastic. All right. Suresh, so I think Shalini's covered all of the major points here, but I wanted to focus on that lock-in period. What does one have to bear in mind? And usually when you talk to new investors, you tend to give them advice saying equity is something that you should hold at least for a period of 5 years. Here the lock-in is 3 years. So it's a good thing to have that lock-in. But how do you plan for that? Do you exit at the end of the lock-in or do you keep it invested?
So that's a very good point you have raised, Alex. A lot of people tend to think that since this is a 3-year lock-in product, at the end of the 3 years, they will have to take it out and they will have to invest elsewhere. See, any investment that we do, whether it is ELSS or any other investment, it has to match with the overall objective of the investor. So ELSS has a 3-year lock-in, which means that in the first 3 years, they will not be able to touch that investment. But that does not mean at the end of 3 years, you will have to immediately go ahead and do the redemption. As long as the ELSS is the right product to stay invested, it makes total sense to continue to be invested in that. Because at any point in time, if you want for any requirement at any point in the future, you can always redeem that. And Shalini had covered about the taxation. It will be taxed at 10%. So, I mean, unless, of course, there is a real requirement for redeeming after just 3 years, it is not recommended that they should redeem it after 3 years. They should consider this as a proper investment which they are making for the long term, with, of course, the kicker of the ATC benefit that they are getting in the year of investment.
So therefore, and that's a follow-up question for you, Suresh, the amount that would normally go into an ELSS, and people look at this primarily from the perspective of saving tax. And so you generally look at your employee provident fund contribution over the course of the year. You look at 1.5 lakhs, you deduct your contribution to the EPF, whatever is left over as a lump sum, usually in the month of March, in the last week, possibly even 2 days before the deadline, you put that entire amount into an ELSS. Usually, invariably, this is what has happened. That's the reality of it. But should that be the limit of what you put into the ELSS, or can you consider putting much more than that, say 80,000 or 50,000 or 30,000, depending on your contribution to EPF, into the ELSS?
So let us step back a bit about ELSS itself, or about investments itself. See, the point is we will have to invest not from the tax saving point of view. Tax saving, of course, is incidental, and that is desirable to have in whatever investments we are having. So we want to make tax efficient investments. So ELSS definitely gives that tax saving option in the year of investment under ATC. So coming to your question, that is, if somebody already has a certain amount of investment because of various other investments that they are making, which include the EPF, I would ideally suggest that they consider investing only the balance amount which is required to cover ATC benefits in ELSS. Because ELSS, if you actually look at it, it is just an diversified equity fund. It can be a large cap oriented, or it can be a multi-cap fund, or it can even be a passively managed fund, which is actually tracking an index. So there are a lot of open-ended funds also which are available, which are doing exactly the same thing, only that they are not subject to that lock-in. So my point is, if the funds are going to be managed exactly in the same manner, and beyond a certain level, you do not require that lock-in, where you really want to keep it open and flexible, I don't see any particular reason, unless, of course, that equity ELSS fund is doing amazingly well as compared to the whole lot of open-ended diversified equity funds. Unless and until that is true, I would not suggest anybody to put in a ELSS funds. And the fact is that is not true. All kinds of open-ended funds are available in the diversified equity space. So there is no reason, if you ask me, for somebody to invest beyond that whatever statutory limit that they require from the ATC investment point of view. I would suggest them to put money into appropriate investment options which are available to them in the open-ended space. Okay. One last point is that in the open-ended space, there are much more options as compared to the ELSS space, because like I said, ELSS, it will be large cap or large and mid cap, and maybe passively oriented funds. So that's the only diversity that you get in ELSS. Yeah. The diversity which you have in the open-ended space is much more. So for all the obvious reasons, I would say one should look beyond ELSS, beyond that ATC limit.
Okay. So that's a fair point. And we are going to break down how to select the fund in the ELSS category. And I have to slip into a quick break. But before we do, very quickly, Shalini, do you hold to the same view that you should utilize a limit of ATC, and beyond that you shouldn't look at ELSS?
So my limited point is that if investors do have a long-term horizon and they find schemes doing well, I think that's something they should explore. And in my personal experience working with fund managers, Alex, when we see the fact that they do not face redemption pressure because clients cannot take out money for 3 years, I've seen that they manage funds in a slightly different manner. At least that's been my experience. And I was just very superficially looking at the best performing mutual fund in each of the categories. And I think except for a pure small cap fund, which is of course very volatile and therefore risky, the ELSS schemes had performed the best. So I think even on a standalone basis, whether it's the redemption decision after 3 years, or whether it's do I put in more than the statutory minimum, I think it can be a category that can be explored because the fund manager style can be significantly different.
What we're going to talk
and I've
about,
seen, behavior change quite drastically for
Absolutely.
a fund
In
manager.
fact, that's exactly what I wanted to talk about. And we will get into how to look at the performance of these schemes in just a bit. As I mentioned, we have to slip into a very quick break. Please do stay with us. We'll be back before you know it. Welcome back. You're watching the Mutual Fund Show, and we're speaking about equity-linked saving schemes, popularly known as ELSS. We've spoken about what the category is about, and we've come to the conclusion, if I can call it that your experience in this category will depend to a large extent on the style of investing by the fund manager and the portfolio construction. So let's get into how to select these schemes. Shalini, I'll come to you. I had asked you to look at a couple of funds that you look at very closely and tell us about the portfolio construction, about the style, and what you've gleaned from this information.
Right. So some of the schemes that I've been tracking, and in fact, which I personally invest in myself, are actively managed funds. Like any other mutual funds, there are two styles, of course, active and passive. So I'm talking about the active style now. These would be schemes where the fund manager is very deeply involved in selecting the stocks and managing them. His aim would be to outperform standard market benchmarks and try and deliver alpha to the investor. Now, while these do come with a higher cost because there is an associated fund management fee, you also run the risk that the fund manager calls could go wrong. But having said all of that, having looked at a lot of the schemes in the space and their construct, there are a couple of schemes maybe I can take as examples, to describe what it is that I would look at while evaluating and selecting. So two of the old well-known names really that I think most people would be familiar with. One is the HDFC Stables ELSS Tax Saver Fund, and the other is the SBI Long-Term Equity Fund. Now, some of the things that I always look at is, one is that, does it have a long track record? Has it displayed its ability to perform? Secondly, is it consistent over various timeframes? So is it not just a 1 year, amazing performance, but it's 3, 5, 7, 10 years poor? So each and every time frame needs to be given sufficient weightage to ensure that they've been doing it a long time and with a consistency. I also like to look at, for this category particularly, large fund houses and with a stable AUM. So that's something that's important to me. Also look at funds which are largely almost entirely invested in equity. So while the minimum for an ELSS is 65%, these funds pretty much operate as pure equity funds. And as Suresh said, should form a core part of your long-term equity allocation, not just for the purpose of saving tax. I also like well-diversified funds, again, for some degree of stability. Since we are locked in for 3 years, you can't exit. So both these funds that I mentioned do have, 40 to 65 stocks and generally stay quite well diversified. And they would generally have, more than half their portfolio in large cap names. Now, within the category as well of active management, as Suresh did point out, you could have a small cap, mid cap, multi-cap focus. And that's where I prefer for a 3-year lock-in product to look at ones which have more of a large cap orientation, so to speak.
Got it.
So these are some of the things that I would look at, and that does reflect in the performance.
Indeed.
Whether you look at a 1 year or 10 year.
Yeah, and we played that on the screen while you were speaking as well. But Suresh, there's also now a few passive options available. And I, at least personally, must confess that I thought that was eminently sensible because invariably the large cap portion of your portfolio forms the core of your portfolio. And generally we've spoken about passive strategies being preferred in that large cap category. So why not choose passive in ELSS as well?
Yeah. So as far as ELSS is concerned, I mean, this is there is going to be a definite lock-in of something like 3 years. Even you will not be able to do anything if your active fund is doing badly. I'm not saying that it will, but I'm saying if there is any need for reallocation into some other fund, you cannot do that. My point is, I mean, as a part of our overall allocation into equity, we require a certain bedrock of large cap allocations. So this is probably actually fitting right into that, in that this is a long-term allocation. Anyway, there is a lock-in of 3 years. So why not actually just get into an index, something which is tracking an index? And this is part of the long-term allocation. We don't have to really bother too much about this portion. And whatever portions which are part of the overall investment portfolio, which need to be apart from large cap, those things we can have active or other portions which we can manage also at the portfolio level. So that is my thought. I mean, I want to keep it as a no-fuss portion in the portfolio, the ELSS portion, as a no fuss portion in the portfolio. And at least the way I construct portfolios, it is a small portion of the client's portfolio. So I want to keep it quite simple.
Fantastic. All right. In fact, I wanted to breach one more topic, or rather broach one more topic, which is that, should you look at SIP as an approach or a lump sum? And in fact, Shalini has provided some very interesting data in that she said that SIPs are a great way to look at this product as well. In fact, over a 1 to 10-year period, quite consistently, the SIP approach has in fact beaten a lump sum approach. But, unfortunately, both of you were completely out of time on this edition, and I wasn't allowed to or able to give you the opportunity, Shalini, to make that point. Pleasure speaking to both of you, Shalini as well as Suresh, on this program, and look forward to the next chat.
Thanks, Alex.
And viewers, I hope that this conversation helped you out as well. If you've got questions for us, do write to us on any one of our social media platforms, and do stay tuned. Lots more coming up on NDTV Profit.
Markets give up early gains, but nearly day's low. Nifty above 21,650. Sensex near 71,800. Broader markets in tandem with benchmarks. And meanwhile, Polycab hits a lower circuit after Income Tax Department unaccounted cash sales of rupees 1,000 crores. All eyes on what lies ahead for the company now. Corporates leave currency unhedged as stable rupee overshadows uncertainties. That's an NDTV Profit exclusive. And TCS and Infosys to kick off the earnings season. Analysts expect muted revenue growth on the back of margin pressure and gloomy demand outlook. And it's an exclusive. Maruti Suzuki's chairman R.C. Bhargava estimates 15 to 20% of total production from EV by 2031 and the first lot of EV cars to be exported. Hello and welcome. This is Last Trades. I am Agam Vakil, and in this show we take you through all that is happening in bulk deals, block deals, and volume buzzers for today. But before that, let's take a look at the markets. And as far as markets are concerned, it's been a fairly quiet day, even though we have seen advances for the benchmarks. Both the Nifty and the Sensex currently trending higher by about 0.25%. And as far as some of your key names go in terms of constituents, which are in fact making that pull and push with respect to the benchmarks, let's pull that up as well. Let's take a look at where we are in fact seeing an increase and where we are seeing a decrease there. So we do have the likes of Infosys and L&T weighing down on the indices. On the other hand, a heavyweight like TCS providing a little bit of support towards the upside. We have seen more strength as far as Reliance Industries goes as well, and of course an advance coming through out there. So about 100 points when it comes to advances and about 59 points leading to a little bit of pressure. All in all, a largely flattish index at the moment. Let's also take a look at broader market indices and see what's in store there. And as far as your broader markets go, we are looking at the mid cap and the small cap indices outperforming the benchmarks by just a bit. A good 0.8% up move coming in there as far as the mid-cap and the small-cap indices go. And a lot of that is largely on account of a handful of names too. Really what's buzzing in trade, but what's weighing down on the indices is, of course, Polycab. On the other hand, there are several beneficiaries where we are seeing a rotation of trade. And speaking of that, let's take a look at all the stocks which we will have in focus in today's session of Large Trades. So first up, we talk about Polycab and of course the income tax issues and challenges there. And in comparison, we talk about what's happening in Havells and KEI Industries, which are in fact also buzzing on very heavy volumes. We also talk about Ease My Trip as it moves and diversifies into a new business. And of course, MRPL is the other one, which is looking at a strong up move in today's day of trade. We'll be talking about that as well. Right at the top, we start off with Polycab, which has been under tremendous amount of pressure ever since we've got news that the Income Tax Department has, in fact, come up with pulled up several issues with respect to the company. We're going to say no more and get in Smriti to talk to us about the updates here. Smriti, good afternoon.
Good afternoon. Yes, Polycab has been in focus today after the Income Tax Department came out with a release last night talking about incriminating evidence that they found against the company that includes cash sales of about 1,000 crore. Along with that, there are some non-genuine expenses. That's the claim that Income Tax Department is making. And they're also talking about 400 crores, over 400 crores of payments made by authorized distributors for the raw material that was bought on behalf of the company. But let's look at what options does Polycab have here. Now, it's important to understand that there's no demand notice as of now. The Income Tax Department hasn't, or at least it has not come out. So there's no tax demand as of now. These are just claims made by the Income Tax Department, and we're seeing a knee-jerk reaction in the market to that. Now, Polycab has an option to when they get the demand notice, they appeal and go forward with it. Second is, if they think that the search and seizure operation was unfair, they can actually file a writ petition in the High Court and get it quashed if that is possible for them. That will be decided in the